I'm Dr. Nelva Lee, CEO of Cbld Crypto Financing. Cbld, tokenizing properties, tokenizing wealth, unlocking liquidity, accessibility, and transparency in real estate investments. The problem. Real estate is one of the largest asset classes globally, but remains highly illiquid. The reason, high barriers to entry for retail investors, such as high capital requirements as well as lack of fractional ownership. There's also a lack of transparency and inefficiencies in traditional real estate transactions. There's also limited access to global real estate markets for smaller investors. The global real estate market is valued at over 300 trillion, yet only a fraction of investors can participate due to the high entry barriers. The solution, Cbld. We first of all tokenize real estate assets, fractional ownership of high value properties through blockchain technology. This increases liquidity. So these tokenized real estates can be traded 24/7 on secondary markets. This leads to accessibility. Lower minimum investment thresholds enables retail investors to participate. There's lots of transparency since blockchain ensures immutable records of ownership and transactions. And lastly, global reach. Investors can invest in tokenized real estate from anywhere in the world. The key differentiator, Cbld focuses on commercial and high-growth real estate markets, offering unique opportunities for investors. The market opportunity. The global real estate market is valued at 300 trillion. The tokenized real estate market is projected to grow to 26 billion by 2034. What are the growth drivers? Increased demand for fractional ownership, rising interest in blockchain-based solutions for traditional assets, and institutional adoption of tokenization. Our target audience are retail investors seeking alternative investments, institutional investors looking for diversified portfolios, and real estate developers seeking new funding mechanisms. Here's how it works. Cbld identifies high-value real estate properties, such as luxury homes or commercial properties. Then we tokenize them. Properties are tokenized on a blockchain. We prefer Ethereum, but we could also use Polygon or Base to create digital tokens representing fractional ownership. Investors then purchase these tokens representing shares in the property. Investors then earn returns through rental income, property appreciation, and token trading. And lastly, these tokens can then be traded on decentralized exchanges or other platforms, providing liquidity. Here is the Cbld buy box. We buy commercial properties that are 50 to 200 units built in the 1980s or after, and return ratios of 9% for cash on cash, 6% minimum for cap rate, and DSCR minimum of 1.4. So these are the locations where we prefer to purchase our commercial properties. Atlanta. Why Atlanta? It is the best place to live in the US. It was also voted #1 best city to start a career. It was also voted #1 busiest airport, #1 city to start your own business, #2 city for professional opportunities, #3 city for quality engineering universities, #3 city for metro for STEM professionals, as well as metro for corporate professionals or corporate headquarters, and #4 for metro area for tech diverse indexes. So we all know that Coca-Cola and Home Depot call Atlanta their home, but did you also know that a lot of companies stake their hubs or regional hubs or headquarters location in Atlanta as well, such as Google, Airbnb, and Cisco? The other location that we're focused on is Charlotte, North Carolina. Why Charlotte? It's the second largest banking center in the US. Bank of America, Wells Fargo, and Truist all call Charlotte their home. With booming tech and healthcare sectors, it continues to attract new residents seeking affordable urban living. Their studio units, for example, are increasingly popular among their remote workers and recent grads, as well as single renters looking for efficient, well-located housing. There's ongoing investment in their public transit and infrastructure that further supports the outlook for Charlotte's small unit rental market, positioning them as value asset class in the housing mix. As I mentioned, it was voted #1 city for remote workers, for tech workers specifically. So here's some return scenarios that we like to give to our investors. So these are for investors in our commercial properties themselves. We start off those investors at 50,000. We prefer obviously 100,000 or 250,000 investors. Here's why. We have a best case, most likely, and worst case scenario. Best case scenario, we exit in 2.5 years, okay? And we give you 100% of your returns back. Most likely scenario, we will exit in about 5 years with an 80% in total return. And worst case scenario, we exit in 2 years, but with only a 12% return. Average cash flow in the best case scenario is 9%, as well as average annual return of 40%. Most likely, though, your average cash flow is going to be about 5% with an annual return of 16%. And worst case scenario, we get an average cash flow of 3% with average annual return at 6%. What this looks like for the investor classes that we mentioned is if you invested 50,000, you can expect that in 2.5 years, you will get your $50,000 back. Okay, 100% of your investment. So we basically doubled your investment. Most likely, though, you would get about 40,000 back. That's 80% total return. And worst case scenario, 5,785. That would be a 12% return, which is still about what the stock market is providing. For our $100,000 investors, best case scenario, you double your investment within 2.5 years. Get $100,000 back. Most likely, though, you'll get about $80,000 back. That's an 80% return. Worst case scenario, you get 11,570 back. Okay, again, that's a 12% return. $250,000 investors, same deal. Best case scenario, 2.5 years, you get your total $250,000 return, double your investment. Most likely, you'll get about $200,000 back with that's an 80% total return. And then worst case scenario, 28,925. That's about a 12% scenario, 12% total return, which again is very similar to what the stock market is doing. Now, for those who are unable to have those type of capital and unable to invest directly in our commercial properties, you can then invest in the tokenized future cash flows. So what we do is we partner with different sellers and we tokenize their equity. But when we sell them to those who are purchasing these tokens, it's tokenized future cash flows. Their equity, you would be purchasing the future cash flows. Those investments start at 10,000. Again, democratizing ownership of real estate. Though very similar best case, most likely, and worst case scenarios, so that a $10,000 investor can expect to double their investment in 2.5 years and receive another $10,000 within that time frame. $20,000 investor can double their investment in 2.5 years, best case scenario, and receive $20,000 back, most likely 80% total return, and that's a $16,000 return. Worst case scenario, 12% returns, and that's a $2,314. Very similar to our $40,000 investor. Again, best case scenario, you hold for 2.5 years, you can receive double on your investment in that time frame, and that's $40,000, best case scenario. Most likely, you'll get about 80,000 or 80% return, and that's $32,000 back. And worst case scenario, 12% total return, and that comes out to $4,628. So let's look at what an example of what this looks like for a seller. So let's say that a seller has an original sale price for this 50 unit apartment, and the original sales price is $10,500,000. The NOI, however, is $674,000, and it has a cap rate of 6.4%. This does not pencil in for the buyer until you enter the seller tokenizing their equity. So on column 1, you'll see that the sale price is $10,500,000. The debt on that would have to be $7,468,500. That's including all the closing costs and all of the other factors that goes into that debt. But in this first column, we do not have the tokenization, right? And therefore, the total raise for that buyer would have to be $3,031,500, which makes this a very difficult purchase for the buyer. However, column 2, you'll see where the original sales price is still the same, $10,500,000, but the debt is significantly decreased to just $4,660,500, because the seller was able to tokenize their equity, $4 million of equity in this property, and therefore reduce the raise for the buyer down to just $1,839,500. So tokenization makes deals work. What is our competitive advantage? Cbld focuses on commercial real estate, targeting high growth, high value properties. We are regulatory compliant, adhering to global regulations such as MiCA and SEC to ensure investor protection. We've partnered with leading blockchain platforms and real estate developers, and our technology leverages cutting-edge blockchain technology for secure and transparent transactions. So here are our revenue models and our revenue streams. We can earn money through transaction fees. There is a small fee on each token transaction. We earn money on property management fees, percentage of rental income from tokenized properties. We earn money on token appreciation. We expect the value of our Cbld tokens to increase as the platform grows. Our projected revenue is that the first year we would have a projected revenue of 10 million. Year 2, 20 million. Year 3, 50 million. And lastly, our partnerships. We believe that our revenue from collaborations with real estate developers and blockchain platforms will also yield dividends. Here are our tokenomics. We have 1 billion Cbld tokens in distribution, and this is how we have distributed it. 40% for property acquisition and development, 30% for investor rewards and staking, 20% for team invested over the 4 years, and 10% for marketing and partnership. And you can find us on your platforms, your decentralized platforms, under the code Cbld. Here is our utility. Number 1, you can use it for fractional ownership of real estate assets, as described earlier. Second, staking rewards for long-term holders. And lastly, governance. Token holders can vote on project decisions. So what does the phases look like? Our roadmap, what does it look like? So platform development and MVP launch happened in our phase 1. And our token sale is still available on our website, concretebl.org. Phase 2 is tokenizing our first commercial real estate property and launching secondary markets for token trading. Phase 3 is expanding to international markets, such as Europe and Asia, and partnering with institutional investors. And phase 4, we expect to launch governance features for token holders and expand our tokenized real estate portfolio to 10 plus properties. Here are our partnerships: blockchain partners, Ethereum, Polygon, and Base; real estate developers, leading commercial real estate firms; regulatory advisors, legal firms specializing in blockchain and real estate compliance; and institutional investors, where we will gain interest from BlackRock, Goldman Sachs, and other major players. So here again are our financial projections. If we can get to about 10,000 token holders, our revenue will be at $10 million. The revenue of 20 million equals about 50,000 token holders. And once we hit the 50 million mark, we should also hit 100,000 token holders. The key metrics: the return on investment for early investors, take this in mind, it will be 5 to 10 times your investment, your initial investment. And that is because we expect our token to appreciate 200% in the next 3 years. So here's your call to action. Join us. Invest in the future of real estate with Cbld. Participate in our token sale and become an early adopter. Help us revolutionize the real estate market through blockchain technology. Contact us at concretebld.org, email us at support@concretebld.org, or follow us on Twitter or X at Cbld 2025, or on YouTube at Dr. Nelva Lee. Thank you. Thank you for your interest in Cbld. Let's build the future together.